Welcome back to Squawk Box this morning. We are live from Davos, Switzerland, and we are joined now by legendary investor. He doesn't like when we call him that, but Paul Tudor Jones is here. He's the chairman of Just Capital, of course, chief investment officer of Tudor Investment Corporation, and we're thrilled to see you this morning.
Good to be here,
We've had a number of conversations about where we are in the economy. I want to show you what Ray Dalio said in just a moment. We also saw what the president had to say about the economy. But before we get to Ray's comment, wanted to get your assessment of where we are.
Well, we're just, again, in the craziest monetary fiscal mix in history. It's so explosive. It defies imagination, and I don't think anything's changed. It reminds me a lot of early 99. So early 99, we had 1.6% PCE, 2.3% CPI. We have the exact same metrics today. The difference is Fed funds were 4.75%. Today, they're 1.62. Back then, we had a budget surplus, and man, we've got a 5% budget deficit. You can't make it up. We had an impeachment. We just had 3 rate cuts because we had this external crisis. So crazy time.
So you want to be on the train, and then you need to get off of it pretty quick if it's 99.
Well, not really. The train's got a long, long way to go if you think about it, what happened in the ensuing 12 to 14 months. I would say we've got a curveball with this coronavirus. I think that's a big deal.
Well, I hope not.
I mean, it is. If you look at what happened in 2003, it was estimates range 0.5 to 2% of GDP for China, 0.5% for Southeast Asia. Stock markets sold off double digits. If you just look at the escalation of the reported cases, it feels a lot like that.
It's an old virus. We know a lot about this virus, I think. I would think we'd be able to develop something pretty quickly.
There's no antidote. There's no vaccination.
Can't do it.
There's no cure. We don't even know what the incubation period is.
Right.
And you're obviously getting ready to go to the biggest travel period in China. So when we're going to find out, we kind of know how lethal it is. It seems a little bit less than SARS was, but we don't know how virulent it is, and now we've got this time bomb of travel taking place in China.
So are you seeing through this or not? Right. I mean, on a morning like today, when David Tepper on Friday...
I'm a trader, not an investor.
Correct.
So if I was an investor, I'd be really nervous. If from a trading standpoint, there's zero way I'd want to be long until... we really need about 2 weeks to see what type of spread we get. I know I just saw something before I walked in here. I don't know whether it was the actual Chinese government reporting it or whether it was just someone estimating, but it said 118 cases suspected in Hong Kong. If that was the case, that's a huge deal.
Can I just back up, though? Everything you said before you mentioned this latest coronavirus basically sounded like just what Tepper had told Joe on Friday, which is get on the horse and ride it, because everything's been set up to mean that stocks are going up, with the exception of a possible curveball like SARS.
Yeah, well, and in 99, you had a bunch of 6% corrections. This one might be, again, more meaningful, because I do think this epidemic's a big thing, because you've got such a much higher rate of travel, a much higher chance of infection. You're already in 3 or 4 countries. And yes, I think it's a big deal. So
more
clearly, we've got monetary and fiscal conditions that would argue for some type of a blow-off that will ultimately be ended by the Fed hiking a lot sooner than they even begin to contemplate. Yes, I think David's right. I do think what's happened in just the last 4 or 5 days is hugely impactful.
Let's show you what Ray Dalio just said to us in the past hour. I want to get your reaction.
The issue is you can't jump into cash. Cash is trash, okay? Cash is that they're going to, because they're going to print money. What do? You get out. Okay, so cash is not going to be
So what do you do?
So what you have to do is you have to have a well-diversified portfolio. First of all, you have to be global, and you have to have balance.
Making the argument effectively that when, in fact, you do get off the train is not a cash train. You can't, that cash effectively becomes devalued. And he's made the case, by the way, also for gold, even though I know he made it clear to us he didn't want that to be his headline.
Right. Again, we're in such extraordinary times. We've never seen a fiscal monetary mix like this. So it argues for some massive blow off at the top. And at the top, whenever that might be, remember, between now and the top in 99, the NASDAQ was up 130%, right? So at the top, I would argue, but that's a long way from now. At the top, rates theoretically be substantially higher. They're not going to be 1.67 with this mix. They will not be here forever. There will be, the animal spirits will go, the stock market will go until at some point the Fed gets in the game from this insane monetary policy they're running.
Want to pivot. You're here on behalf of Just Capital. This is your first time here in Davos, by the way.
I'm so privileged to be here with all the muckety-mucks and talking heads. I mean, wow, I'm just overwhelmed.
You can feel it, can't you?
But one of the issues, as you know so very well, is this idea of sustainability. It's one of the big themes this week. And yet we were talking a little bit about what may be the hypocrisy of it all, in large part because Becky was at a dinner last night. It didn't come up as a topic until sort of late in the game.
And only because then they mentioned it had not come up to that point. And then we went back to the China.
Right. You have a lot of CEOs here who seem to be very happy with the President Trump, and his economy. He did a bit of a victory lap just in the past hour or so. Of course, he has a very different view of climate and sustainability. So what gives in all of this?
So if I'm just going to hijack that question a little bit. I think you can boil it down very simply. In 1970, we had profit margins 6%. Today, they're between 11 and 12. Last year, we had $2 trillion of corporate profits. If we were back in the sharing arrangements of 1970, $1 trillion, instead of going to shareholders, would have gone to employees, customers, communities, and the planet. So this social divisiveness that we have, what we're seeing playing out in the political arena, while we have two socialists that have a great chance of being the Democratic nominee, is because the sharing that we have currently is not working for the majority of the country. And the American public, from our polling, we say, what is just corporate behavior? And they tell us there's 29 components. Number one is fair wage. Number two is ethical leadership. Number three is living wage. You know what the 29th component is at 1.2%?
What?
It's shareholder return. So you've got this massive dichotomy between what the people want and what the C-suite's delivering and what we're going to do over time. And I was really heartened because I was at a CEO dinner last night. And what we're going to do is rearrange the sharing. It's not going to be just about shareholders first. If you remember back in the 60s, when the sharing was completely different and we had a 6% profit margin versus 11, GDP growth was twice what it is today. Now, I want to give you a...
Isn't that, though, partially because there was no competition outside of the United States at the time?
Well...
So that they could share it more with the employees, and because they could have effectively higher rents, if you will?
I don't think it's binary. I think there's shades of gray in everything. That's a very good point. But I think the most important point is that we know what's happening right now is causing millennials not to believe in the system. We know that there's a threat to free markets, which is the best way to allocate resources, in my opinion. I'd much rather see us change the sharing agreements organically bottoms up, where CEOs put employees first, put the planet and communities and customers on par with shareholders. If you had a blank sheet of paper and we were starting and trying to maximize societal happiness and output, and we had those five stakeholders, shareholders, employees, customers, communities, the planet, would shareholders be the most important thing to manage companies around? I don't think so.
We got to go, but then how much of this is about business trying to get ahead of regulation? And that would be the cynical take.
I think, well, from what I heard last night, I think CEOs love the idea of the new business roundtable definition where all stakeholders get even, because they want to put their employees are the most important folks.
Shareholder return, all that really measures is the profitability of the company and how it's satisfying its customers and its employees and its communities and everything else. And then the stock ends up and then shareholders make money. No one wants zero profitability and flat shareholder returns. That's not going to help anyone. Then you can't do anything. Okay, so it's like a chicken egg thing.
But again, it's shades of gray, right?
Okay.
And we've gone too far, and we've got to come back.
Paul Tudor Jones, thank you.
Thank you
so
so
much for
much.
being here. Welcome to Davos.